Welcome, everybody. We're glad to have you here for our December webinar talking about the Affordable Care Act and reporting and what's next. This is a monthly webinar hosted by Employer Solutions Group, Century 2 Staffing, and Professional Staff Management. We're really excited today to have Howard Cox, who's a CPA with Somerset CPAs. We've done a lot of work with Howard over the last couple of years trying to get ready and be prepared and execute some of the required reporting that's already happened. And then, as luck would have it, as Howard will talk about, even more changes have happened just over the last couple of weeks, and I guess we can only say what we know as of today, because we may expect even more changes as the new year begins. But we're very excited to have Howard. He's very versed working with a lot of different clients on ACA compliance, and he's definitely been our hotline in terms of, for our PEO divisions, any questions that we've had. So Howard, I'd like to go ahead and turn it over to you, but let me mention one thing. At the end of the webinar, we will give a few minutes for questions. So feel free to type those in the chat box on the webinar itself, and we will do our best to address those at the end of the session. We will record the session, and the slides will be made available, and those will automatically be sent to any of the participants on the website after the webinar is concluded. So Howard, appreciate you being here. So tell us what we need to know.
All right, very good. Thank you, Kim. If you could advance to slide 5, the welcome and agenda slide. Really just want to accomplish kind of 4 broad goals, and then endeavor to save some time for Q&A, which I think is oftentimes the most valuable part of the session. And so those 4 broad goals are to kind of talk about some of these things that have been very recent changes, and most of them favorable for a change, which is always nice. And then really talk about, obviously, all of us have one, well, maybe not all of us, but many of us have one reporting season under our belt. Some of us may be new to reporting this year because our businesses have grown. And thirdly, just really talking about overall risk management as it relates to the ACA and some very specific problematic areas that we've seen or want to make sure we don't see as to some fairly significant potential penalty exposure relating to the Act, at least as it stands today. And then lastly, talking about something that those on the call may or may not have had a lot of experience with, but we expect to have more volume of subsidy notifications to employers and potential appeal filings. So we want to make sure that we address that a little bit as well. So on the next slide for hot off the press, there's actually something working its way through Congress as we speak, which is called the 21st Century Cures Act. And like a lot of pieces of legislation, there's a lot of content in there, and not all of the content necessarily relates to the name of the act. So the act really has to do with reforms relating to the development of drugs primarily. But buried in there is a provision that would allow small employers to provide health reimbursement arrangements for their employees without penalty in the same way that we did before the ACA. And they define small as what we've kind of become accustomed to, fewer than 50 full-time equivalent employees. So anybody that is not an applicable large employer, and those are the ones that have 50 full-time equivalent employees or more, would be able to have an option to have a health reimbursement arrangement where you reimburse employees for individual market premiums like we did prior to the Act. So that has passed the House. still has to pass the Senate, would still have to be signed by the President, but it does appear to have pretty wide bipartisan appeal. So just kind of watch for that. So that's pending good news for small employers. Something that already happened and is extremely good news is IRS Notice 2016-70, which came out the week of Thanksgiving, I think maybe the Tuesday or Wednesday before Thanksgiving, and it did two really, really critical things. One that is pretty self-evident, and one that is probably even more powerful and maybe didn't get quite as much press, but the IRS provided an automatic extension of the of providing the 1095-C forms to employees, and or 1095-B forms, depending on whether you're a carrier or whether you're an employer. But I know most people on this call are employers, so what we care about is the 1095-C, and that was due to get to our employees by January 31. And there was an availability of a 30-day extension if you read the instructions, but it was not an automatic extension. And so what Notice 2016-70 did was give everybody an automatic 30-day extension. So there is no longer any extension available for distributing the forms to your employees. Everybody now has been given that 30-day grace period. So every employer has the same due date, and 30 days from January 31, because February is a short month, ends up being March 2nd. So that is the due date for all employers, and there is no extension available now because it went ahead and automatically granted the 30-day one that was allowable. So that's of course very welcome news. Now also in that same notice that is actually probably even more important is they continued the good faith standard for the completion of the 1095-Cs for another year. They gave us, kind of the essential equivalent of a warm-up year for the 2015 1095-C filings that we did in the first quarter of 2016, and then we were to go live in 2016 with the full force and effect of a requirement of those forms being correct or us being subject to penalty for errors. But in Notice 2016-70, we not only received the automatic 30-day extension, but we also received another year extension of the good faith standard to where we won't be held to the full standard of perfection in our reporting until the 2017 reporting that we will be providing in January of 2018. One last little quirky thing about the notice is it ignored the due date for us to file those forms with the government. So it addressed the due date of filing the forms with our employees, but ignored the due date for providing it to the IRS. So those due dates are still February 28th for paper filers, those that are filing fewer than 250 1095-Cs, and then March 31st for electronic filers, those primarily that are filing 250 1095-Cs or more. Now again, if you want to look at the instructions, there is a 30-day extension available for filing with the IRS. That is an automatic extension. You do have to file for it, and there's a particular form that you file for it, but you can get a 30-day grace period by filing the extension form before the due date. So that's just a couple of updates there. Probably the next most important update isn't quite as hot off the press because the various iterations of the forms and instructions started coming out over the summer and then into the fall, and we now have final instructions and final Form 1095 Cs and 1094 Cs for 2016. And really, I think good news for all of us that already had a year of dealing with this is they didn't really make too many changes, made some clarifications, and a lot of those clarifications were consistent with things that we had assumed. So for the most part, there wasn't anything that was really problematic in the new versions of the forms and instructions. The one thing that had been rumored that they were going to do, and they did, was provide an additional form for a conditional spousal offer. So there was some confusion when we did the 2015 filing in 2016 of what code to use on line 14 for an offer code if you had a conditional offer to a spouse. So it was pretty easy to figure out what code to use if you offered coverage to the spouse. But if it was a conditional offer, there was some confusion. And so they created a new code, which is 1K, that you now provide if you are offering coverage to your employee and coverage to your employee dependents and spouse, but only if that spouse is not eligible for coverage at their own employer. So that was kind of the one change or addition to the coding. Kim, let's go ahead and go to slide 7. And I then wanted to just reflect on, at least from the calls that we took at our office from employers who were going through the inaugural 1095-C reporting cycle, as to kind of what the biggest areas of confusion were on lines 14, 15, and 16. So line 14, to refresh your memory or introduce you to it, depending on your familiarity with the form, is where you describe the offer that you made to the employee. And a common confusion point there was that people would think, and logically so, that they should be speaking in terms of an offer to the employee in relationship to the employee's ability to accept that offer. So the best example of that is maybe you did offer coverage to your employee and their dependents and their spouses, which was a very traditional kind of offer, which happened to be a code 1E as in Edward. But then people would say, well, gosh, that employee is single, so maybe I should use the code that I offered it to the employee only, which was 1B as in boy. So, but the offer code doesn't have to do with the employee's ability to accept your offer. It has to do with what your offer actually is. So if you offer coverage to the employee and their dependents and their spouse, you always use 1E as in Edward, whether they are married or single, or whether they elect single coverage or family coverage, none of that matters. It's a 1E. So that was one area of confusion. On line 15, and again, as a refresher or an introduction, line 15 is where you were to provide how much you charge for employee self-only coverage. So for many employers, that's reasonably straightforward, although that is not always the case. But for many employers, you charge one flat fee for employee self-only coverage. In other cases, it may be age-dependent or it may be income-dependent. But whatever that case may be, people would get confused is they would think they should report how much was being withheld from the employee's pay, which could be something completely different, because if they elected anything other than self-only coverage, then what was being withheld would be different than what you were charging for self-only coverage. But line 15 was specifically for just what you're charging for the employee's self-only coverage, regardless of whether what coverage they elected. So on line 16, which is the line where you describe what happens, I guess the best way to describe line 16 is it's really, as an employer, it's your get-out-of-jail-free card that you play. So line 16 is designed for you to describe to the IRS why you should not be subject to the employer mandate penalty with respect to that particular employee. So it's fairly straightforward that if you make an offer to the employee and the employee accepts that offer, that you can't be penalized because you've made an offer, that offer's been accepted. And that wasn't too much of a source of confusion, and that was a code 2C as in Charlie. But what would happen is if the employee would decline coverage, then sometimes there would be some confusion about, well, what code do I use if they decline coverage? And that's where the safe harbor codes came in, which were 2F as in Frank, 2G as in George, and 2H as in Howard, depending on whether you were utilizing the W-2 safe harbor or the federal poverty level safe harbor or the rate of pay safe harbor. So those were some areas of common confusion. If there were areas that you had questions or concerns about, please log those into the chat window, and Kim will read those back to me at the end of the session. Kim, let's go forward to the next slide, slide 8, the ACA compliance and financial and tax considerations slide. So kind of the next bullet point on our agenda was really kind of talking about some of these overall risk issues. So what are the risks? What are the things that we need to be thinking about as an employer? Well, one of them is the the excise tax implications, and we're going to have several slides where we talk about those. And those are the
Sorry, everyone. Seems like we've lost connection with Howard. Let me see if we can't get him back on the line. Please hold 1 second.
Hey, Dave?
Yes.
Dave, I'm still on the line.
Excellent. We just must have lost the communication there for a little bit, Howard. We hear you loud and clear now.
Hear me now?
Yes, a little bit of interference, but we do hear you.
Okay, excellent.
We can continue on. Thank you, Howard.
All right, very good. So the, going back to kind of this ACA compliance to financial and tax considerations slide, the, we've got these estate tax, these excise tax considerations that we're familiar with, but we want people to start thinking more about your potential obligations as it relates to financial reporting. Now, this may or may not apply to all of you. Maybe you do just tax return reporting. Maybe you don't have financial reporting obligations to financial institutions. But to the extent that you do, and to the extent you have some excise tax liability, then really that's a liability that needs to be recorded on your financial statements. And also you have a responsibility to ensure that you have appropriate systems and processes internally to guard against the imposition of those excise taxes as it may relate to, particular problem areas as an employer, which might be the offer of employment, the hiring and onboarding of the employee, the making of the offer of coverage, the typical kinds of trouble spots, and what are your systems and processes around that, and are they documented, and have they been tested, and all types of internal control considerations. So those are just things that I know for a lot of us, we were just trying to get through the first reporting year from a 1095-C, 1094-C reporting aspect, but we also need to be cognizant of how this impacts our financial reporting. And then also this area of responding to these public exchange notices. We need, we'll talk more about those later, and you may not even know what those were, and maybe you didn't see any, only because the federal government sent out a fairly small number of those as kind of a test of their systems. But As we describe more how that works, I think you'll better appreciate that that's just another potential trouble spot now as an employer, that we need systems and processes around making sure that those public exchange notices are getting to the right parties, and that responses are being provided when appropriate and on a timely manner. So again, I think we'll see more about that on future slides. So if we can go on now to slide 9, Kim, which is we're going to talk about some of these very specific risks. And one of them, and we're going to have a little more discussion about this later because it's a potentially very thorny area, is misclassified contingent workers. So these are those workers who you don't think are employees, but the Internal Revenue Service may think are employees. And they can be a significant problem as it relates to the imposition of both penalties in the overall penalty regime of the Act. And we're going to talk more about those penalties in a second. But those misclassified contingent workers can be a problem for both of the penalty types that you can be assessed, and we'll describe that more as we drill down more into that topic. The next risk, again, I kind of alluded to in the prior slide about we've got to make sure that we have these internal controls and that they're documented and tested. So next slide, we'll talk about risk 3. This is the other type of penalty that you can receive. Risk 1 was the so-called A penalty, which we're going to talk more about in a second. Risk 3 is the so-called B penalty, which again we'll talk more about in a second. And then risk 4 really is, do we have the information that is necessary with which to successfully execute our employer reporting obligation? And that is where, again, we received a little bit of good news as to the continuation of that good faith effort standard for another year, but we still shouldn't underappreciate how much attention we should be providing to what we need to do from a systems and processes and policy and procedure standpoint of data aggregation in terms of all the data that is necessary for the filing. So next slide, we're going to talk about these excise tax considerations, and very specifically the A penalty. And I want to spend just a few minutes because there's a risk exposure with respect to this penalty that is not self-evident and not necessarily all that well understood. So the penalty itself is the penalty if you don't offer coverage. So one would think that you would know whether or not that penalty would apply to you, because as an employer, you know whether you have determined that you are not going to offer coverage, in which case you're going to pay the so-called A penalty for 4980HA is the code section, or you would know that no, you have decided you are not going to, offer coverage, you're going to pay that penalty, or you would know that you're going to offer coverage, then you shouldn't owe that penalty. So you would think it would be that straightforward, but it actually is not that straightforward, and it's not that straightforward because of the second sub-caret down there where it talks about the minimum coverage that is necessary for you to have made a compliant offer. So you say as an employer, I know whether or not I am offered coverage. Well, you may or you may not, because if you offered coverage, but because of a lack of systems and processes, or executing properly on those systems and processes, or having enough bandwidth, or having good enough training, or whatever it is, if you only offered coverage to 94.9% of the people you were supposed to offer coverage to, then you don't get credit for having offered coverage to anybody. You didn't make an offer of coverage that is compliant by the Act, therefore you didn't make an offer of coverage at all. and you owe that that A penalty, that $2,160 times all full-time employees, regardless of whether or not you offered them coverage, you still get penalized. So that is probably one of the biggest things that we stress whenever we talk about ACA compliance and ACA compliance risk. Next slide, we're going to talk about the B penalty. And the B penalty is when you've made an offer of coverage that is compliant as required by the Act. You have met the 95% offer standard. If you've got 100 full-time employees that you would be required to offer coverage to based on the code and regulations under the Act, and you successfully offered coverage to at least 95 of them, then you dodge the bullet and you're not going to owe the A penalty described on the prior slide. But that doesn't mean that you aren't going to owe any penalty at all. You could owe some of the B penalty for very specific employees. And one of the areas where I think there was some general confusion in the first year of reporting is people thought that these ones that some people thought that these ones that you missed, you just missed them, and as long as you met the coverage standard, then you'd be fine. Well, as long as you meet the coverage standard, you don't owe the A penalty on all of your full-time employees, but you would, in fact, owe the B penalty on the ones that you missed. So it isn't good enough to meet the coverage standard to beat all of the penalties. It's just good enough to beat the A penalty. You still owe that B penalty on the ones that you missed, which goes back to those systems and processes and training and controls around offering employment, onboarding employees, making that offer of coverage, documenting the offer, documenting the waiver of coverage as applicable, all of those types of things. Because even if you beat the A penalty, that doesn't mean you're going to beat the B penalty on every single employee. And as we were talking about that line 16 on the prior slide, and that being the get out of jail card that you play as an employer, if you run through all of the codes that are available on line 16 and none of those codes end up being applicable, then that is what triggers the IRS to believe that you are going to owe a penalty for that particular employee for that particular month. And if you had enough blanks on line 16 to where it is determined that you didn't meet the coverage requirement, the 95% standard, and some of you may remember that as the 70% standard because that was a transitional rule for 2015, and then beginning in 2016, we have to meet the coverage standard that is in the regulations, which is the 95% test. And so that line 16 is very important. If you run out of codes and there are none that are applicable, then you're going to have a penalty for that employee in that month. Speaking of penalties, we talked about some good things that have happened, and there may be, as Kim alluded to in her opening comments, there may be, more employer-friendly changes coming down the pike. We'll just have to wait to see. But one of the things that you have to not look forward to after the holidays is if you were going to be subject to any employer mandate penalties for 2015, you may, and maybe very logically, think that if you haven't received a penalty notice yet, that you probably don't owe any penalties, but that you shouldn't be that confident about that, because no penalty notices have been sent out to date, at least that I am aware of. And there's speculation that those penalty notices will be going out in the first quarter of 2017 based on ACA reporting for 2015. that we completed in 2016. So I know that gets very confusing, but just be aware that the first quarter may be very busy as it relates to penalty notices for 2015. It also may be very busy as it relates to these public exchange notices that we're going to talk about more here in a few minutes. So that's just a little bit of a refresher on the A and B penalties. So where are some of these risk areas on slide 13, these excise tax considerations? Well, maybe our definition of a full-time employee is not consistent with the Act. Therefore, we're not offering coverage to everybody we should be offering coverage to. So we're going to have the B penalty for everybody we miss, or we could owe the A penalty if there were enough people that we miss. So if we still are only offering coverage to people that are working, say, 40 hours a week as opposed to 30 hours a week, then we wouldn't be in compliance with the Act, just as a simple example. So how are we defining a full-time employee, and is it consistent with the Act and related guidance? Number two, that issue with contingent workers that I mentioned, and I'm going to mention again, and there's a few more slides that drill down into that, and those are those people that we don't think are employees. We think they are vendors, we think they're independent contractors, we think they're 1099 versus W-2 people. If those are W-2 employees, if the IRS believes that they're W-2 employees, then we would owe the B penalty potentially for not having offered them coverage, and or if we had enough of those workers reclassified, we might fail our 95% test and therefore owe the A penalty on all of our employees. So again, that's a particular area that we reinforce, is that even if you did offer 95%, even if you did offer coverage to 95% of the employees that you thought you had, if the IRS thinks you have more employees, you may inadvertently fail that coverage test. Staffing, employees that you employ through staffing firms can be problematic. That can be really straightforward. It depends on the relationship you have between you and the staffing firm and the way that you've negotiated your contracts and the typical tenure of your employee. And it's a fairly complex topic that I don't want to get too far off onto, but basically, as long as you are engaging in temporary staffing, which is generally, excuse me, I may have lost you for a second there. As long as you are engaging in temporary staffing, which is typically viewed as staffing of a tenure of less than a year, and as long as your contractual relationship with your staffing firm properly documents who is responsible and who is paying, and your invoicing shows that if the employee that you're employing through the staffing firm is receiving coverage through the staffing agency, that you are receiving an upcharge for that, all of that can be fine, and those people are not your employees. If you run afoul of any of those rules, then you could end up having more employees than you thought you had. Variable hour employees, it depends on your business model as to whether or not you have variable hour employees. And variable hour employees are essentially, again, you could do a whole session just on this, but they're employees who, at the date of employment, you don't know whether they're going to be full or part-time. And so you need to track them individually during their first year of employment to see whether or not they are averaging 130 hours a month, and if so, then onboarding them with a benefits offer accordingly. As you can imagine, that can be very problematic, or I think you can imagine that would be very problematic in terms of tracking. Union employers have potential challenges, although under the current safe harbors, it's fairly easy to do ACA reporting for union employees. On the next slide, other potential kind of problem areas. Interns, generally, if they're being employed for 6 months or less, and they're being employed at more or less the same time every year, they're summer interns, whatever the case may be, they're generally going to be excluded from reporting under the seasonal employee rules. But again, those are just things that you've got to pay attention to. Rehires, as you may or may not be aware, if you have a sufficient break in service, which I believe is 13 weeks, then they come back in as a brand new employee, subject to your normal protocol for onboarding employees and wait periods and et cetera. But if they don't have a break in service of that duration, they come back with the same benefit standing they had when they left. Foreign employees, and particularly probably more problematic are the ones we may be bringing here from foreign countries versus the ones we are sourcing out to foreign countries, but that's another potential problem area that's highly technical that you need to be aware of. If you're doing any merger and acquisition work, we get involved in a lot of that, and ACA compliance is something that we really emphasize in diligence, because particularly if we're doing a stock purchase, then that's, the non-compliance of the target can become our problem. The more employees you have, the faster your employment is growing, the more turnover you have, the more you really need to emphasize all of these systems and processes and training and internal controls that we've alluded to earlier in the call. The more locations you have, the more decentralized your operations. Again, the more potentially problematic it is to comply with the Act, and the more you really have to emphasize systems, processes, training, technology, testing, that type of thing. Next slide, kind of some final potential difficulties. If you fall into these categories, you just need a heightened sense of risk awareness. If you have multiple entities and related parties, and you have employees who may work for more than one of them from time to time, determining who within that group, whether or not there is ACA reporting mandated, and if so, by which party, knowing whether or not they're full-time and whether or not you have to offer coverage can be problematic if you've got multiple EINs and employees moving fluidly between those. Dependents and dependent Social Security numbers, particularly, or I guess specifically if we're self-funded and therefore have to fill out Part 3 of the 1095-C. Third-party data for anything that is being fulfilled in terms of our employment by third parties. The hours of service and tracking hours of service. We potentially, at least we've run into situations where employers have employees that they haven't traditionally tracked hours, and now we've got to have those hours tracking capability. Goes back to those kinds of systems and processes. COBRA and pre-65 retirees and our reporting obligations. Those are just kind of areas that if as these things happen, you just need to be certain that you know how to handle those. The next slide, slide 17, is kind of that good news that we got, where they extended that good faith effort of ACA accuracy of reporting on to 2016. But again, we've got to make sure we're road ready in 2017 to make sure that we're going to be able to accumulate all of the data to comply with 100% accuracy for the employer reporting. Otherwise, there are fairly significant penalties, as many of you may be aware, to the extent that you have errors in your filing. You got your filing done, but you had errors in your filing. And those penalties can be, I think they've been indexed for inflation, but they were $250, and then you could be penalized if you made an error in your reporting to the employee, and also made an error when you filed the copy with the IRS, and depending on how late it was that you corrected, or if you corrected it, potentially there were scenarios where you could end up with, depending on your employment base, of course, you could end up with penalties as high as $6 million. One other real quick note about that good faith effort, because we talked a lot about that earlier and we just mentioned it again, is just a reminder that you only get the good faith effort standard as opposed to the 100% accuracy standard if you file your ACA reports timely. And that includes within the extended time period that they provided, but you have to file timely in order to get that good faith estimate standard. So the next slide having to do with financial statement considerations, I don't want to get too deep into that. It's just something that we want people to be cognizant of, that if you have penalty exposure, you know, that's bad, of course, but if you've also inadvertently misstated your financial condition to your bank, then that can take something and make it you know, kind of a double negative. So we just want people to be thinking about, if you believe you could have some exposure penalty, you need to make sure you're accruing that appropriately in your financial reporting. The next slide really talks again about that data risk, and as you know, any of you that have struggled with ACA reporting, we've got a lot of different data coming from a lot of different databases, internally, externally, combinations of all above. So again, just making sure that we are addressing those potential risk areas. The next slide starts several slides on the, oh, I'm sorry, the next slide is slide 19. We're just kind of wrapping up the financial statement considerations. Those of you that are controllers or CFOs, just be aware of these areas that you need to make sure you've got defined and documented systems and processes, and you know, I've tested those systems and processes. So that's kind of a mini checklist for CFOs and controllers. The next slide starts a series of slides that we aren't going to delve into too deeply, but wanted you to have a nice takeaway, is this area of contingent workers, and are they an employee, are they a vendor, an independent contractor, are they a 1099 reporting, or are they a W-2 reporting? And you know, there's several slides on this, but we could do, you know, an hour session on that alone. These issues have been around for as long as I've been practicing CPA, for 33 years, because it's always mattered for fringe benefit reporting when it came to retirement plans, but now with the ACA, just the risk of misclassification is elevated, because now you can potentially have an ACA problem as well as an ERISA problem. So slide 20 deals with that issue, as well as slide 21, slide 22, slide 23, slide 24. I want to go all the way to slide 25, which is the notices from the public exchanges. So they sent out the first batch of notices in June. They were dated June, but most employers didn't receive them until actually early July. And again, they didn't, when you look at the total number of our national employment, the number of these notices that were sent out was relatively small. So it may be that you have no idea what I'm talking about. But be aware of the fact that the public exchanges have always had a responsibility, but until recently haven't had the capability to notify employers when their employees are deemed to be eligible for subsidy. And we expect a much higher volume of public exchange notices to be going out in 2017, and we expect them to be going out earlier in the year. We don't expect the IRS to be, or HHS, I think maybe HHS is one that sent out the notices, but we don't expect them to be waiting until June to send those out. We expect them to be sending those out much more timely after open enrollment on the public exchanges, and so it could be as early as, April or May. You'll be getting these notices, and the notices are fairly straightforward. They basically just say, "Dear employer, this specific employee, was deemed to be subsidy eligible, and if you believe that that determination was incorrect, then you need to file an appeal within 90 days." And the employer appeal is pretty straightforward, and in terms of the information that it requests, and then you need to attach to that response any underlying documentation to support your contention as to why the employee wasn't subsidy eligible. They either weren't employed or they were not a full-time, well, if they weren't a full-time employee, they actually were subsidy eligible. It's just you wouldn't be subject to penalty. But if they weren't employed by you, clearly they weren't your employee, so you shouldn't have penalty responsibility. Or if you offered them coverage and they waived it, then you wouldn't be, they wouldn't be eligible for subsidy and you wouldn't be penalized. Or if they were in fact on your plan and yet had been deemed to be subsidy eligible. And those notices come from Health and Human Services. You respond to them in their, I think, London, Kentucky office, and those are important notices to be on the watch for and to respond to accordingly. The next slide talks more about that, slide 26, just about the fact that they started coming out in June. They've always been supposed to do this. Slide 27, and the notices from the public exchange, kind of continuing on, talks about one of the problems that you can have with these is that they may not have been sent to the address you really wanted them sent to as the employer. This goes more to people that are at multiple locations. The employee, when they filled out the form to apply for a subsidy, may have used the address where they work, not the headquarters where you would have liked to have the notice go. It was not uncommon for employees to have filed for subsidy when they really shouldn't have, just because they didn't understand it, because it is very complex, as we all know. The next slide kind of really goes into the conclusion slides, and then there's, and I don't want to belabor this because we've kind of already been through all this, but slide 28 has to do with the conclusions, and slide 29, and then slide 30 just gives you some takeaways and some things that you should be talking about internally in your organization. Slide 31 is just a basic bio on me. And then what I really wanted to save time for was Q&A. Kim, have there been any questions that have been posted during our session?
I don't see any questions right now, Howard. If anyone has one, feel free to put that in the chat box. We're happy to address any questions. Well, if there are no questions, again, Howard, I want to tell you how much we appreciate you presenting this today. We may have more questions for you when we hang up the phone and have digested all of this information, but we appreciate you sharing with that today and helping us, give us some thoughts to for planning. We appreciate everybody.
Well, you're very welcome. Kim, if you might, just because we've got just a couple of minutes, I thought I might make, since we've got time, I might make just a couple of general observations, and then I'll let everybody get back to their busy work days. But given that we have time, I wanted to add a little bit of speculation. I know on people's minds is what is going to be happening to the ACA in the future. Obviously, that's anybody's guess, but I will tell you kind of that what we suspect you're going to see is changes in different buckets of the Act under different timelines. So in a nutshell, the Act was a very all-encompassing Act, and many of you are probably aware of that. It was a couple thousand pages, and there's been 20 or so thousand pages of guidance issued. There's a lot in it. And one of the purposes of the Act was to reform the health insurance industry and how health insurance was offered. So that's one big bucket. And those are going to probably take the longest to change, because toying with the insurance industry and the offer of insurance can be destabilizing, and we believe that that will likely be done on a very cautious basis. So it may be 2 or 3 years before there would be any changes to the part of the Act that was specifically related to the reform of the offer of health insurance on a national basis. No annual limits, no lifetime limits, age 26, dependents can still be on parents' plans, those types of things. Early indication is that the federal government may be inclined to more push that back on states rather than it being federally mandated. But in any event, we believe that is a long-term time horizon because of just the risk of destabilizing the insurance industry. The second big bucket would be the individual mandate. As many of you will remember, that was one of the really hotly contested areas all the way to the Supreme Court, was determined to be constitutional, and but it is really one of the sections of the Act that a lot of people were unhappy with. But it also has a lot of implications to the insurance industry and is also perceived as being potentially destabilizing if that particular aspect of the Act is removed or removed prematurely. So we don't necessarily expect immediate action on the individual mandate. The third bucket is really the employer mandate. That's probably the one where that the people on the call are most invested in, and that is probably an area where we are going to see more action, and more action quickly would be areas of relief for employers. Even if we get employer relief, we're certainly going to have ACA reporting for 2016. I don't see anything changing that. And I think we will continue to have employer reporting as long as the individual mandate is in effect, because the employer reporting fills a couple of purposes. It does fulfill an information request that the IRS needs to enforce the employer mandate, but there's also aspects in it that are helpful as it determines whether or not a citizen has fulfilled their obligations under the individual mandate. So we could potentially get employer mandate relief, and that wouldn't necessarily extend all the way to employer reporting relief. Might modify employer reporting, but not eliminate it. Also, one last comment, and then I know everybody wants to get back to their day, is that even if there's a general consensus, which I believe there is within the incoming Republican administration and Republican-controlled Senate and House, that there are changes that people want to make to the ACA, having a consensus of wanting change and having a consensus relating to specific change and getting agreements as to specific changes is another thing. And also, even though the Republicans will control the White House, Senate, and House, their margin of control in the Senate is so small, since they have less than 60 senators, that they would have to overcome filibusters in an effort to get hotly contested legislation through the Senate that didn't have broad bipartisan support. So all of those things are things that still lead us to saying, as of today, it needs to be business as usual. Understand the risks that are embedded in the Act and the things that we need to do as an employer to manage those risks and mitigate those risks. And with that, I'll just thank you all for your time and attention today and turn it back over to Kim.
Great. Well, we appreciate that. And certainly all the PEOs, we will continue to do updates and additional webinars as changes are made, just to keep you abreast of any of the changes that may take place in the next few months. Again, appreciate everybody's time today. You will get a copy of the slides, and join us for our January webinar, and be looking for the invitation in your email soon. Thank you, everybody.